Well, President Trump's trade war, as you well know, is already causing cracks in Canada's economy. And if Trump doesn't relent, the economy could be headed towards a cliff. That's the warning today from the Bank of Canada Governor Tiff Macklem.
U.S. trade policy has taken a dramatic protectionist shift. Tariffs and uncertainty have sharply reduced prospects for global economic growth, and financial markets have been rocked by chaotic policy announcements and reversals. A long-lasting trade war poses the greatest threat to the Canadian economy. It also increases risks to financial stability. In an extreme case, market volatility could turn into market dysfunction.
Okay, so how likely is that doom and gloom scenario? Well, Peter Armstrong is the CBC senior business reporter, and he joins us now from Toronto. So, look, Peter, I don't know if a lot of Canadians are going to read the Bank of Canada's financial stability report, but there's a lot of urgent messages in there. So what do Canadians need to know about what's in this document?
Yeah, I think you're right. I mean, they call it the FSR, and it's of all of the Bank of Canada reports, it's probably the one that's deepest in the weeds. It measures kind of, the stability of the entire financial system. So banks, non-bank financial institutions, consumer credit, business solvency, all this stuff. And Tiff Macklem had a great line today that he says, you do your forecast for the monetary policy report, you try to put together these scenarios for the different kinds of reports they're looking at. But when they do the FSR, he says, you got to put on your gloomy hat and really get a sense of how bad things might get. And as we know, the downside scenario here can get pretty bad. And when you look at it, you can kind of see if tariffs continue or get worse and talks fall apart, that will lead to a recession. A recession is going to exacerbate all kinds of problems within the economy, but specifically around debt. Canadians are still quite notoriously overburdened with debt. That's going to cause problems with the banks. The banks are going to freeze up spending and loaning and lending. And the way you can sort of see these problems ripple through the economy is on the one hand quite predictable, but on the other hand, frankly, it's pretty scary. And it's the bank's job to try to measure what that would look like. And you sort of go through this report line by line, and you can see them trying to reinforce this notion that this isn't a forecast. We don't think this is going to happen, but we've got to game out what might happen. And when you start to go down that road, from any perspective, right? Like I've been talking to businesses and shippers and retailers and all of these different groups, and all of them are kind of doing the same thing of gaming out, well, what if things fall apart? How is this going to look? And the answer universally is it's not going to look very good.
Yeah, you've got a scenario in there from the International Monetary Fund, like 5% GDP contraction, 9.2% unemployment, housing prices drop by 26%, and equities markets fall by a third, right? Over 30% from peak to trough. I mean, these are grim scenarios, whether they're likely or not. Yeah. That's kind of the dark potential. But it's not just the Canadian central bank, the head of the U.S. central bank. He's already warning of severe economic consequences this week. Jerome Powell says he can't predict how bad it could get because he can't predict Donald Trump. Just have a listen to this.
There's so much uncertainty. If you talk to businesses or market participants or forecasters, everyone is just waiting to see how developments play out, and then we'll be able to make a better assessment of what the appropriate path for monetary policy is.
So, I mean, Peter, it's not good when the heads of the North American central banks are talking about all this uncertainty and Jerome Powell warning about high unemployment and high interest rates. So what does all of this tell you?
Well, and what he's sort of also implying in all of that is we are moving from the sort of anxiety over, in theory, what this might look like stage into the bite of these things actually starting to affect the economy. Right. One really good example of that is the shipping world. All of these tariffs kick in not when they arrive on American shores, but they're backdated to the day they left, in a lot of these cases, China. And it takes 4 to 6 weeks for one of those massive container ships to arrive at the port of Los Angeles. You skip back 4 to 6 weeks, and we're basically at Liberation Day. It's taken this long for these ships to get here. And now we've seen a lot of them start to turn around. There's going to be this massive drop-off in the amount of stuff flowing into the United States, the amount of container ships. I will remind you, the most common job among Canadian men, the most common job among American men is truck driver. And you're not driving a truck with a lot of stuff in it if nothing's coming off of those ships at the ports of Los Angeles and the ports of New Jersey and the ports of Seattle. This and all of that, David, is set to start taking place essentially in the next few days. So next week, we're going to see a measurable dramatic drop off in the amount of stuff flowing into the United States, it will have an immediate impact on truckers, on retailers, on, we've talked a lot about, Donald Trump saying, well, instead of buying $10, you buy with $2 or whatever it is. That reality of not having as much stuff you can buy off the shelves at the major retailers, that's about to come, and it's coming literally next week.
Yeah, and it's machine parts, it's inputs into U.S. manufacturing industries. I mean, the containers are coming back empty now. The ships may just not go if this keeps up, right? That's where it could all go. All right, well, Peter, we've got that to look forward to and to talk about the summer. This is CBC senior business reporter Peter Armstrong. Thanks, man.
You bet.
U.S. President Donald Trump's trade policy is prompting some central banks to raise concerns about the economic outlook. Both the U.S. Federal Reserve and the Bank of Canada are warning about the potential impacts of the U.S. tariffs.
If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment.
The big message in this report is we now face a new threat. The trade war poses new risks. So even if things were moving in the right direction, it's a really good time to get prepared for possible turbulence ahead.
Matthew Holmes is the Executive Vice President and Chief of Public Policy at the Canadian Chamber of Commerce, and he joins me now. Matthew, it's good to see you again. Thanks for being here today, sir.
Thanks for having me, David.
I wonder your high-level reaction. What do you make of Bank of Canada Governor Tiff Macklem's economic warning saying that a long-lasting trade war poses the greatest threat to the Canadian economy?
Well, frankly, I'm not surprised. I mean, it's an incredible amount of our economy is reliant on trade. We've always been a trading nation. And the U.S. relationship in particular is a disproportionate amount of our trade. And so the disruption that we're seeing with the U.S. trade war and the threat that poses not only to businesses that are directly trading with the United States, but the broader economy that relies on those businesses, on those jobs, and on the economic multiplier effect that those bring our broader economy. So it's real. This trade relationship is very important, and the precarity of the global trade situation right now is a deeper concern. You want to make sure there isn't a contagion that sort of takes hold and ripples through quite broadly.
The unfortunate thing, according to the forecast, is the economy was looking pretty healthy, until all this happened, moving in the right direction. Insolvency rates and debt ratios had been improving in Canada, but now we have some of these gloomy. It's not a forecast, but it's modeling done by the International Monetary Fund that, the worst case scenarios are like GDP to fall 5%, unemployment to peak over 9%, housing prices to drop 26%, and equities to fall 36% from peak to trough. I mean, what needs to happen to avoid sort of those pretty dark numbers right there?
Well, I think it is important to underscore what you just said, that this isn't a forecast. This is sort of a worst case scenario. It's an annual report, the Financial Stability Report that the Bank of Canada puts out. And you'll recall last year we were looking at a real concern around the amount of household debt,
right,
and what that might mean at renewal for mortgages. What we're seeing actually in this report is that debt level at the household level has come down, and for businesses as well. But the risk is that with the broader trade war, with the impacts that we just talked about a bit on how that could really undermine the Canadian economy in the short term, that then accelerates or exacerbates some kind of broader economic effect, which could be quite crippling in some respects. So yeah, that worst case scenario that I think the governor called it his Moody hat he was putting on to look at the sort of dark clouds on the horizon. That is a role that we look for the Bank of Canada to play, to give us a sense of how bad could this get and what are the safeguards, what are some of the things that we need to be ready to do if that's the case.
Right. It's not a forecast, but it is a potential outcome if things continue on a bad path and there's no change. And we've seen, we saw pretty dire warnings from the Federal Reserve. Chairman Jerome Powell's essentially warning of stagflation, saying that he's lost the ability to sort of guess the right path when it comes to interest rates, and the possibility of high interest rates and high unemployment are growing in the United States. I mean, how does that affect us here if Jerome Powell's warnings prove true?
Well, I think we're seeing this in multiple places. It's our Bank of Canada, it's the Fed in the United States, but remember, I can't even count how many companies have come out in the last week or two and withheld their earnings reports or their forecasts. And that's basically at a corporate level what they're telling their shareholders they expect to earn this year. So if the companies can't do that, and we as citizens are really the shareholders of our economies, we can no longer do that. It really puts a light on the sort of uncertainty that the current U.S. administration has injected into the global economy. And we're seeing that ripple through in various ways.
So what are the policy options here, monetary policy and fiscal policy? Because, Tiff Macklem, they held rates last time after making a consecutive series of cuts. I think you wait and see before you decide what lever you have to pull there. But, as Mark Carney continues his transition and builds a new cabinet, they're going to have to come out with a budget. I mean, what are the things they can do to sort of buttress against the downside risk that all of these forecasts are highlighting?
Well, there's a number of things. And the Canadian Chamber's Business Data Lab did a forecast early on the possible effect of tariffs. And what we saw at that time was that this looks a lot like the 2008-2009 financial crisis. So we're not talking about pandemic level interventions by the state, and we're not looking at that kind of economic crisis at this point. We're more expecting to see, a possible recession in the third quarter seems to be what a lot of people are saying. Remember, the third quarter starts in July, so that's not too far away.
Yeah.
And so what we might see is, it'll start with people starting to sort of just chill a bit in terms of their spending, both companies and individuals. And as that takes hold, we could see that deeper effect where there could be job losses, and we start to see insolvency both at the household and business level. And that's what this report is articulating is how far does that go? And how bad does it get before we start to see it corrected? Now, in the pandemic, we saw governments really intervene with a high level of spending. And what we've been saying at the Canadian Chamber for a while now is we don't want to see that kind of level of spending again if we can possibly avoid it, because what we saw then was that incredible inflationary impact take hold afterwards and the sort of volatility in the marketplace. What we really want to see, though, is an economy that captivates, that pulls in capital, that is a place to invest. And so I know that sounds like a bit of a counter trend right now, but if we look at the U.S. and the uncertainty that's being injected into the global economy, and we say, look, Canada is a relatively stable place. We have an incredible resource-based economy, and we have one of the most diversified marketplaces in the world in terms of who we can trade with. This is a place to come and start a business, to grow a business, to invest in a business. And we have a relative stability in a world that's suddenly very uncertain and unstable. So there is that potential there if we can attract private capital and we can really unfetter business. And that's where government policy comes into place, is allowing the business and the private sector to start the spending that we need to see to create the healthy economy that our communities need.
Right, and that's certainly a through line, I think, of what Prime Minister Carney is pitching. And a lot of the premiers, quite frankly, Wab Kinew is making the same point, that we can unleash private investment by offering incentives and sort of keeping things stable. But just as a final point, Matthew, I mean, we saw the Oval Office meeting this week. Pete Hoekstra, the new ambassador to Canada, is out saying the 51st state is behind us. So that's a good start. And today, I mean, President Trump is calling it a trade deal. It looks more like a term sheet, as the start of something with the United Kingdom. The rhetoric is going down and tariffs are going down, at least with the United Kingdom. Do you see hope in that there can maybe set this aside between Canada and the United States in the next little while?
I have a lot of optimism coming out of this week. I thought that was the right reset that we needed. And on a number of levels, it's a very relational moment. We need a prime minister and a president who can speak to each other, who can respect each other, that can go into a room and close the door behind them and have a discreet conversation. And that's what I saw. More important than the Oval Office meeting was that they had a fairly lengthy meeting with the right people around the room, both ambassadors, senior members of the cabinet on both sides, in a room, door closed, starting to talk turkey. And that's what we need to see. And that's the beginning. It's not there's no quick solutions here. I mean, even the UK deal that was just announced still affirms tariffs and
Yeah.
quotas. So it's not really a free trade deal. It's an agreement on we're going to tax you this much and we're going to only let this much of your product in. So I'm not sure there's a first mover advantage here for the UK. I want to play this out a little longer, I think, if I'm a trade official looking at the scenario that's about to kind of take hold in the United States as we see supply chains really kind of choke up and less products available to consumers. I think that actually plays to Canada's benefit. We have a lot of what they need in the United States, a lot of what they want. And so let's see how this plays out.
Matthew Holmes, always appreciate the insight. That's Matthew Holmes, Executive Vice President and Chief of Public Policy at the Canadian Chamber of Commerce. Thank you, sir.
Thanks a lot, David. Good to see you.